So let's go ahead and graph this line of code for the daily price, just for Apple, right? Just to make it manageable, right? And let me just add the color blue. Now, color, there's two types of color attributes in Ggplot, color and fill. Color has to do with the outline of a graph, whereas fill has to do with like bar graphs and stuff like that. So if I go ahead and run this, I graph this line of code. Here, we have the earnings yield for Apple. Just Apple going from 2007 all the way to 2018. And as you can see, for the most part, it's been positive. For the most part, it's actually been positive. It's been kind of all over the place, but it's been positive. You can see that real quick, we can notice the fact that the fluctuation at its highest was around 4.45, down to about 1, right? So it's EY through that period for Apple has been within that range. And after that range, after 2010, it's been mostly between about 4% to 2% earnings yield. And after 2016, it started dipping down. It started trajectory down around 2017. It looks like it went below 2% earnings yield. All right, so that's the power of visualization. Real quickly, we graphed it, and we got a good idea about where earnings yield has been historically for Apple, right, for most of the time, and early on what it was, and recently where it's headed, and what level it's been at, right? So that's the beauty of visual analytics. That's how quick we got that analysis. Now, let's say we want to layer another line. Notice I use the terminology, layer another line graph on Ggplot. Again, this is kind of more complicated than a normal graphing tool would do it, but the logic here again is that I want to logically build out these graphs in reference to the language of data exploration. That's the whole idea behind it. All right, so let's go ahead and do it. All I'm going to do is, again, do another plus. And now I have another, I'm going to throw another geom line in here, right? But this time, what's going to happen is, because of the fact that I have, even though I already mentioned which table I want to use, this particular table is just for Apple, because I literally said ticker equals Apple. Ggplot has no concept, once again, of the other data in daily price, because all it sees is the data in the columns for just the Apple row. So if I want to graph, let's say add another line. In this case, let's say I want to add the line Tesla to this graph. I would have to give another data source that has the Tesla. And I can do this directly in those graphical those what we call the geometric objects. So this another keyword right here is data equals. And here now I can, let me just copy this data part again. And I can say, hey, you know what? Give me a different table. Let me just do plus so I have more room. Give me another table. I'm using another table now for this new line. It's kind of the same table, but it's going to be a different subset of it. And I can fill in everything else from here as well. I can put the AES directly in here. The AES is going to be the same from here, but I'm putting it in this graphical package. And you can see why these things are written as functions, so these functions can go into different places. All right, so the date and EY is going to be the same thing. And the color, this time I'll make it red. I run this. Oh, I didn't make my change here. Let me make that just Tesla. I run this. And now look what you see, guys. If we zoom in, look what's going on. And let's talk about what's going on. First off, Tesla obviously doesn't have as much earnings yield because, you know, when it went public around after 2010. That's number one. Number two, notice the positivity and negativity of the earnings yield. Apple's earnings yield, for the most part, are positive. They are positive, right? Not for the most part, they are positive. Tesla has, obviously, we know this is up till the beginning of 2018, end of 2017. We know eventually Tesla crossed over into profitability, right? And then it slipped back into negative profits again. But look at this, right? It's always been negative, the earnings yield. Why has it always been negative? As a refresher, because the operating income or the operating profits have been negative. That's why. Yet, Tesla has had an astounding appreciation, one of the most appreciated stocks, as we saw from before, from our other previous labs when we were messing around with it. So what gives? What gives is Tesla plays by a different rule. Tesla is a quintessential growth stock, or in this case, one of my hedge fund buddies calls it a dreamer stock. They like to throw the term around, the dreamer stock. Right? This is a company that is transformative, no doubt. Right? Very big, bold ideas it's trying to do. Very heavy on capital investments, and big on high ideas. Like for instance, in the startup world, you basically put startup ideas into 4 quadrants, right? Capital by 2 basic concepts. Is it capital intensive or is it not capital intensive? And is it what we call obvious, low-hanging fruit, or is it not obvious, right? Tesla is a stock. Not only is it a growth stock, meaning that it's not making any profits yet. People are pricing it based on the fact that they expect it to eventually start making profits, and they expect the stock's price to start appreciating. Okay, that's number 1. Number 2, though, Tesla is unique in the sense that it's in a unique characteristic of startups where it's actually not even a startup, but whatever. When it started off, it's a company that's what we call capital intensive, and it's a non-obvious company. Capital intensive, non-obvious. What does that mean? It means, well, capital intensive is basically we're going to put a lot of money. This company, to run needs a lot of capital. Okay? And what do we mean by non-obvious? By non-obvious, we mean it's a concept that you wouldn't think of doing, like common companies would not think of doing. There's a lot of car companies out there. There's a reason why they haven't done all electric cars. Okay? It's not obvious. It's not an obvious path to solution. Like, for example, I'll give you an example of an obvious solution. All these stupid scooter sharing apps and scooters you see everywhere, right? That's obvious. We went from Uber sharing cars. Then we went to sharing bikes, city bikes. Well, what's the next logical step? Scooters, right? So that's something that's capital intensive and obvious, right? So in the startup world or in the private equity venture capital world, you never, ever, ever invest in a company that's capital intensive and non-obvious. Those are almost surefire disasters. Tesla is a rare exception. Musk and Tesla is a rare exception. Not only is it a growth stock, we deem this as a dreamer stock. And this is quite obvious now that you're looking at this graph right here, right, with Tesla. Tesla's a different beast. And by the way, as many people love Tesla, being that it's a dreamer stock, you have equally amount of people, institutional investors, that hate it, call it a scam, and are shorting the hell out of it. And this is why you have so much instant volatility in Tesla. And this is why I like day trading Tesla. All right? So that's that. And that's basically, but that's how basically you layer up, again, as many line graphs as you want. All right? And this also goes to show you guys that, listen, we have to understand that as quantitative researchers, right? What are we doing? We're doing quantitative value investing. But as quantitative researchers, these ratios, first of all, these ratios don't apply to all stocks. And second of all, if they do apply to all stocks, their ranges are different. The way we approach the values for these ratios for certain companies in certain industries, right? It's different. And that's what quantitative researchers are always playing with. And by the way, it always tends to change. Nothing stays static. Industries change, stock market changes, market sentiment changes, regimes change in terms of interest rates. So quantitative researchers always have to keep going back and seeing, okay, how are these ratios now being applied? What's the new reality with these ratios? First of all, do I need new ratios? And the existing ratios, how are they being applied? Now, let's explore the relationship between EY and returns. Now, you guys know from stats, when we're applying a relationship between two quantitative numbers, right? We use a scatter plot, right? A brief review, basically, of your graphs is that if you're analyzing just a range of values for a numeric column, you can use box plots or histograms, right? That'll show you the distributions. Box plots give you the 5-number summary. Histograms give you the distribution of the number, right? When you're analyzing categorical columns, we obviously use bar graphs. Third, when you compare categorical versus data, numerical data, then that's when we use a multi-box plot. You can use a multi-box plot, where the categorical data is on the x-axis and on the y-axis is your numerical data. And what we're talking about here is comparing numerical to numerical data, and that's where we use Scatterplot. Again, think regression. You guys have done this in your stats class. All right, but first things first, let's go ahead and let's calculate our returns now, because we're ready to start looking at them. So I'm going to go, I can literally just copy this. All right, I guess I'll just copy that. And I'll do the other one for 60. All right, and here now, ladies and gentlemen, I calculated my returns. Okay, so now I'm returns. And now that I have my returns, I didn't do this in my slides. I didn't do it in my slides right here. But now I can get rid of these price columns. I don't need these price columns, right? So I'm going to go ahead and get rid of these price columns. I'll keep my original price, of course, but I'll get rid of the P3, P5, because I just needed them for purposes of calculating my returns. But now I have my returns, I don't need them. Oops, I didn't want to do that. And that's going to be P20. All right, done. So I got rid of those columns. And now we have these returns. So first things first, let's look at 3-day. Let's look at the 3-day return, and let's look at it with the box plot. And this is what I'm talking about. We can compare. Here we're comparing two tickers, Apple and Tesla, and we're comparing those two tickers relative to their returns, their 3-day returns. All right, I'm going to go ahead and copy this. Fix this. Notice I'm filtering. I'm using the in command to filter just for Apple and Tesla. And the reason I'm doing this, guys, is because there's a lot of data. This will crash your computer if you try to graph too much. Is that finite? Let's go ahead and fix that there. Boom. All right, and here you have it. We have a side-by-side box plot, Apple and Tesla, and we're looking at its 3-day returns for those 10 years, 2007 to 2017, right? Beginning of 2000 down to the end of 2017, so about 18 years. All right, so look at Apple. Apple's 3-day returns have been pretty tight between -20 to 20%. Do you see that? It's pretty much equally distributed. That's pretty wild. Now, if we look at Tesla, Tesla obviously has a bigger range, right? Again, growth stocks. Much more negative returns and much more positive returns. You have a nice, look at that, almost 60% 3-day return. All right, in 3 days, you could have made around 60% if you timed your price, if you timed your trade properly. Of course, nobody can properly time the market. There's very few technical traders that can do that, and those technical traders are far and few. Of course, I've met many technical traders that think they're good at timing the market. They are not. All right, most people aren't. So here we go. I mean, there it is right there, the distributions. That's pretty cool to see, right? But if you notice, if you're building a stock investment strategy, it's pretty much flipping a coin right here for Apple, right? And even though Tesla tends to have a higher side over here, it's pretty much the same thing with Tesla. It's like flipping a coin at this point. All right, now let's look at the 60-day return. Okay, let's look at the 60-day return for Apple and Tesla. Now we're just going to take this, and here's the beauty of using R versus Tableau, that's scam, because I could just do copy and paste change a variable, and I'm back in business in terms of analysis. Now let's look at this, guys. Boom. All right, again, this is 60 days, 60-day strategy. So you buy it in 60 days, what happens, all right, versus 20 days. Now from here we can see, again, it's pretty uniform for Apple, even for 60 days. Down here, this is 0 right here. Your box plot over here, because your box plot, 50% of your returns, this is, represents 50% of your return value. So it's mostly positive, right? From this number to this number right here, that's 75% of your data, your returns. So 75% of the time now in a 60-day strategy, 75 times out of 25, you're making the money. You're making the money. You're positive. You're positive. Problem is when you're wrong those 25% of the times, you're wrong. So it's like goes all the way down to negative, looks like I'm going to say 50. These boxes are in terms of 50. So 0, 50, 100%, 150, 200%. So we're looking at negative 50%. There's a possibility in a 60-day strategy you could have a negative 50% return trading Apple. Whereas 75% of the time you'll be positive, right? And you have a situation here where you actually can be around 75% positive returns for Apple. So here now, if I'm a betting man, right, even though the downside is large, negative 50%, right, but the upside is still 75%, and my upside tends to be more than my downside. So this is promising. This is promising as an investor, or more of a trader, if you will. But now let's slide over onto Tesla over here. Slide over to Tesla. And you are now going to see the allure of these dreamer stocks and these growth stocks. And this is why people like me day trade Tesla. Right? Look at this. The 50% of data tends to be, now there's a bit of it that's negative, but it tends to be more over on the positive side. We do have a higher probability of negativity in the 60-day returns, but that is less than 50% return. And now look at my upside. Look at that upside, people. Look at upside. Up here is 200%. This is 100% return. 150%. 200%. We're approaching 300%. Growth stocks. Added by the fact that this is a freaking dreamer stock, right? And again, by dreamer stocks, I mean that you have institutional investors that have crazy valuation models all over the place for what the worth of Tesla stock price could be if it starts consistently making profit with like some level of profit margins. This requires incredible amount of assumptions, right? And this is why they're called dreamer stocks, because these people are coming up with, in their dreams, these valuations, right? But I mean, these dreamer stocks, they provide great opportunity for short-term strategies. In this case, a 60-day strategy. Again, as a betting man, I tend to win big and win more than I lose trading Tesla on 60-day cycles. 60-day cycles. All right, now let's explore let's see if there's any kind of relationship between earnings yield and returns, right? Do earnings yield, some sort of earnings yield value, give me some sort of score, give me some sort of relationship to returns, or in this case, linear relationship, because that's what Scatterplot measures. Go ahead and fix this up. All right. Boom. Get an ugly Scatterplot. Now, here, earnings yield is on x-axis, and our return, 3-day returns, now we're back to that, is on our y-axis. There's a clear line, spaced out group of two patterns, of clusters, right? Now, we basically know previously that this side is negative earnings yield from this point on, and that's probably going to be Tesla. That's obviously Tesla, because we know Tesla has negative earnings yield, right? And this side right here is going to be Apple, because that's positive. Now, that aside, look at is there any kind of pattern you see here? Positive or negative? Not really. It's actually kind of horizontal, right? It's actually kind of horizontal. It's like a thick horizontal line. This is really implying that there really is no direct linear relationship between earnings yield and the 3-day returns, right? That's what it's basically showing, that earnings yield itself does not have some sort of relationship with the earnings, with the with earnings yield, right? So it's not a good ratio to signal, oh, okay, in 3 days, boom, it's going to go up or down, right? And obviously, we know that's not the case. Financial ratio, earnings yield doesn't work that way. That's not the point behind it. And it's very, very difficult to find any kind of quantitative model to give you that kind of accuracy. Although they do have something like that. They do, these quantitative trading firms, they do have ratios like that they keep under high secrecy, right? They give them great 2-3 day strategies. A lot of these heavyweights, they started off with doing 2-3 day strategies that they found these niche opportunities, and they just hammered it and exploited it and hammered it and exploited it. All right, let's change the color. Let's change the color up here again. Again, you know we can use that color feature, a color property. We'll add it to geom point. All right, and here I'm setting this up for because I want to start showing you how we change the color up based on different values. So here, if I make this purple, all right, we have a nice purple cluster. But let's take it one step further. And now let's change the color up based on which ticker it is, based on whether it's Tesla at Apple. And how do we do that? We're now going to take this color property that's here, copy this. We're going to take this color property that's here, move it from geom point, and I'm going to move that where? Into aesthetics. Why am I going to move it into aesthetics? Here, let me do this. Let me move this back up so you can see this a little bit clearer, and let me zoom in a bit. All right. Okay, perfect. Okay, so why did I switch it from geom point, the color property, to aesthetics? Remember, aesthetics is where we define the columns we're going to use from the table to do some sort of analysis. In this case, if I want color to not be based off some color that constant color I define, but instead I want the colors of those dots to be determined based on their ticker values. And now when I run this, boom, look what you see. Look what you see, right? Again, we knew this was Tesla. We have a little key right here. We knew this was Tesla. We knew this was Apple. And obviously it's confirmed for us. So that's also another abstraction. Again, another brilliant way how Ggplot plays with colors to allow you to visualize this data so much better. All right, so that's how you can differentiate, and we can obviously do much more with that. Now, rather than looking at the earnings yield at one return at a time, there's a native function outside of Ggplot in R that called pairs that allows you to do a scatter plot on all the columns. In this case, the numerical columns that we actually want to focus on are earnings yield, return 3, 5, 20, and 60. So what we'll do is we'll give a subset of that table, of those columns, to the pairs function, just for Apple and Tesla, of course. And we're going to see if there's any kind of relationship we can see, right? If we can see any kind of relationship. So let me go ahead and copy this. And I'll use a pairs one. And obviously it's not as pretty as everything else, but it gets the job done. So let me just do enter so you guys can see it. Fix that. Fix that. And now you see right here, within pairs, by the way, the daily price table, you notice how I'm now not just filtering the rows. I'm not just saying, look, I want Apple and Tesla. I'm not just saying I want the filter for numeric values for EY. But now after the comma, I'm filtering the columns, right? And again, you want to do this because pairs is going to force a comparison or a scatter plot for each one of these columns against each other. So we want to just only focus on the columns we're doing the pair. We want to do analysis on. I run this, give it a second, go on Zoom, and it's probably easier to see here on my computer than it's back on my PowerPoint. But here, earnings yield, right, this is where earnings yield is on the x-axis, right, and this is where it's on the y-axis, this way. But as we're going down, this is the return 3 one. We just had that graph before. This is return 5 one. This is the return 21, and this is the return 61. Now, as we can see, there really is, Tesla's a mess. First of all, let's throw that out there. Tesla's a mess in terms of relationship. And it looks like earnings yield has has no kind of linear relationship with the returns. For Tesla, with Apple, it looks like it's virtually zero, except for the 60-day. The 60-day over here seems at 2% and greater. It seems like there's somewhat of a positive relationship, linear relationship between earnings and 60-day returns. Okay, there is some sort of a positive linear relationship there. All right. Now, let's go ahead and graph the 60-day one. Right, just so we get a nicer version of that. So I'll just take where's my point one right here. Press enter so we can see what we're doing here. Excellent. And I'm just going to change this to 60. Oh, let me move this color thing over to the aesthetics. And I'll have this the color be dictated by the ticker value. Boom. All right, and like we said before in the pairs function, as we saw, Tesla is a mess. We need a different ratio for that. But after the 2%, there's a slight positive return here. All right, okay. With the 60-day return. So that's pretty cool. That's pretty cool. How when earnings yield is greater than 2%, you do have a direct positive correlation between, it shows there's a direct linear relationship between earnings yield greater than 2% and your 60-day returns. Now, we could build a model off that. That's pretty cool. But remember, like when you're talking about direct linear relationships or any kind of positive correlation, we're talking about linear regression. And if we're talking about linear regression, there's a whole bunch of tests we need to do to make sure that that relationship is based off of an actual linear relationship that exists and not some sort of random error. If you guys remember from stats, we would have to perform an F test, a T test, et cetera, et cetera. And then even before we even do that, we would have to run what we call our diagnostic graphs. We would have to test our line assumptions, linearity, independence, normality, equivariance. And then we can say, oh, cool, there is a positive relationship, right? So here, this would be the tipping point to do a simple linear regression and go from there. I'm not going to jump into that. We just don't have time for it. But you guys have done this in your classes, and you guys should know what I'm talking about. All right. But if you want to cheat, we could run an investment strategy. We could run our lab again and do a trading strategy where anytime Apple is greater than 2%, we buy, right? And it's 60-day cycles and 60-day cycles. We buy and then sell in 60-day cycles. We buy it and then wait 60 days and we sell it. And we just keep doing this cyclical kind of investment strategy with Apple. We can see how we did. All right, so that is the earnings yield to the returners. Remember, I always stress this: earnings yield is not for the purpose of picking winners and losers, right? Especially with returns, 60-day returns. Even though we do see some sort of relationship, it's there to say, hey, once we have an idea of a stock we want, right? We want to identify, we feel this is a good stock, then earnings yield helps us gauge when we should buy it. All right, whether we should buy it or not yet. Is it if it's fair price? So now we can start talking about the ratio that I want to discuss that basically helps tell us if it's a good business or what Charlie Munger and Warren Buffett call it, a wonderful business. All right, what does that mean? So when we say wonderful, what does that mean? First of all, the ratio is what we call ROC, return on capital. It's a simple ratio, and it's a ratio from the group 2. If you remember the groupings here in the slides, if you remember the groupings, group 1, 2, 3, and 4. Group 3 is, earnings yield is from the group 3 ratios, the ratios that basically help measure price relative to value, quote unquote. Group 2 ratios are basically, they measure how efficient or wonderful a business is, all right? And again, what do we mean by wonderful? What do we mean by efficient? We mean that you're generating cash, this company is generating cash consistently at a high average with as little capital investment as possible, right? So it's highly efficient at generating income. Now, why is that important? Why is it generating it's averaging high amount of cash? When we mean cash, again, think of operating income. Why is it generating high amount of operating income with as little as capital as possible? That goes to efficiency. For every dollar invested in this company, right? For example, let's say it's a ROC of 50%. For every dollar invested, every quarter, I'm getting 15 cents back on my dollar. Or let's annual, more realistic. I'm getting, for every year, I invested $1 in this business, and every year I'm getting 50 cents back on my money. 50 cents back on my money, right? That's a highly efficient business. Okay? An example of this would be let's take a small cafe or restaurant or hole in the wall, right? Very small. If it succeeds and it's successful and it starts having more than one branch, what does that mean in terms of its operating income? Well, I mean, let's say you invested 50, 60, 100, $200,000 in that small cafe or burger shop or whatever you want to call it, right? If it's successful, you will see in those situations a return on your capital of like 100%, 120% a year. So for every dollar invested, you get a dollar back every year. Those are fantastic success stories for restaurants, which is one of the reasons why people try going to restaurants. Of course, we know the failure rates for restaurants are disastrous. I think it's about 80 to 90% failure rate in these restaurants, right? But that's what we're looking for, something like a very efficient business, in terms of the amount of money invested in the business versus how much it gives back to us, right? The formula for ROC is basically the numerator is virtually the same again. We're using operating income. We're not taking the average now. We'll deal with that in a moment. We're just going to take the quarterly operating income. The denominator, it's again very simple. The first part right here, GPP plus AD, that's gross property, plant, and equipment. That's a line item in balance sheet, plus accumulated depreciation. Those two together give you what we call net property, plant, and equipment. All right? Now, what is gross property, plant, and equipment? Let's start there. That is basically any warehouse, any storefront, any factory, all that stuff. All that stuff that you need to make your product or service, that's what that is. Service-based companies, it's your website, it's not your digital marketing. That would be more operating expenses, but it's your, think infrastructure. So website, servers, it's your retail stores that you own, where your people are working at or out of. It's any cars you own, or fleet you own. All that stuff, that capital investment, right, where most capital goes, that you need to basically start a business. That is what we call gross property, plants, and equipment. What's with the AD part, the accumulated depreciation? For any guys that own real estate or your parents that own real estate, you guys know that every year you're allowed to knock off a percentage of the value of that property you own, right? Because the nature of these physical properties is that there's wear and tear, right? They need maintenance. They're getting older, right? They're not as new, and so likewise, their respective value goes down. That's what depreciation is, accumulated depreciation. And AD is always a negative number in our balance sheet. That's why when we always add them together, because it's a positive number, always add it to the negative number. And that gives us the net property, plant, and equipment. And that's what we want. We want that net value. Okay? The second part right here, TCA minus TCL. What is that? Total current assets minus total current liabilities. Now, again, you guys all had financial accounting. You guys should all know what this is. Total current assets is basically your assets within 12 months, your short term. Your total current liabilities are your expenses within those 12 months, all right? Anything that you have, you're going to be receiving money profit-wise within 12 months, and anything you're going to have to pay out within 12 months. When you subtract one from the other, that's what we call your working capital. All right, that's the capital you have on hand within 1 year, in a short term, within 1 year time frame, to keep the business running. You want a positive number, right? If you're a negative number, you're going to have to get short-term financing to help out. And there's a whole niche of financiers out there that do working capital financing. All right, but what is that? That's your short-term assets to run the business on the short term. What is the first part? This is your permanent investment. This is your long-term investment, right? So this together with that is both your long-term and your short-term investment in the business. That's what that is. So if that's your short-term and long-term investment in the business, and your numerator is the operating income, the money you make from that business, ROC now, that ratio is basically telling you how much percentage you're getting back every quarter or every year for every dollar you invested in this business. It's that simple. That's how ROC works, right? A quarterly ratio of 50%, a quarterly ROC ratio of 50% implies that every quarter, this company is making 50 cents on every dollar it invested in that business. All right? The reality is that 1/4 ratio won't tell you that much. We'd like to take an average. And what's more important is obviously the trend of the ROC, if it's growing or declining. And this is why we tend to take an 8/4 or a 2-year geometric mean of the ROC ratio, not arithmetic mean, a geometric mean. And I'll talk about geometric mean in a second. Now, why do we take 8/4 or 2 years? Where did this come from? This is already kind of outdated as I talk about it, because this used to be the standard. But why was this the standard? Because your business cycles, your recessions, right? Your recessions and your growth would be in 2-year cycles usually, right? Back in the days. That really no longer exists. We are now in a totally what we call a boom or bust economy. And now we've even shifted beyond that to now what I call, as of now, we're more in a what we call a corporate socialism economy, where a lot of the old rules are not changing. It's causing a lot of havoc, but I don't want to go too much into this. But so this is where those 2 years things come from. But again, I want to point out that even that time frame is kind of a little bit outdated. All right, but I mean, it's a great place to start. It's a great place to start. Now, why geometric mean versus an arithmetic mean? All right. Now, first of all, what is a geometric mean versus now? Everybody knows what an arithmetic mean is. Okay, that's your standard mean. You guys all know how to calculate it. If you don't know how to calculate it, we got bigger problems. All right, but what's a geometric mean? A geometric mean basically is here you're multiplying your values out. See, over here, what we do is on an arithmetic mean, the answer here is 6. You would add up the numbers and you would divide it by the total amount of numbers. So you add this up. 6 plus 6 is 12, 20, 30. 30 divided by 5, it's 6. All right, done. With a geometric mean, what we do is we multiply the numbers. We don't add them up. We multiply it, and then we raise it to the power of 1 over the amount of numbers there are. There's 5 numbers here, so it's to the power of 1/5. This gives me a value of 5.21, blah, blah, blah. That number is less than 6, right? Why is that number less than 6? Because the way geometric means work is the more variation there are in the numbers that you are calculating, right? The more variation there are in the numbers that you are calculating, the smaller the mean will be to its arithmetic counterpart, okay? The smaller it will be to its arithmetic counterpart. Here is a counterexample. Here, the numbers are all the same, 5, 5, 5. What's the mean of this? It is 5. That is obvious, right? What's the geometric mean of this? It is also 5. You can mathematically see that right here, right? 5, 5, 5, 5 is basically 5 to the power of 5. 5 to the power of 5 to the power of 1/5 is what? This 5 and that 1/5, they multiply with each other to give me 5 to the power of 1. The answer is 5. When the numbers are all exactly the same, that is when the geometric mean is the same as the arithmetic mean. All right? So that's really cool. Why do we use this and why do we care? It is because the geometric mean penalizes ROC values that are variant in nature. For that reason, it'll give a lower geometric mean of the ROC. And the reason we want to do this is because we want to reward consistent high ROC values. And for you to get a consistent high ROC value, your ROC values must be really high, or they must be consistently high. Okay? If you have a situation where you have high, 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 and then a low ROC, that ROC score will be lower than a situation where you have another stock that has slightly lower ROCs, but they're all consistent. And that's the beauty of geometric mean. And that's the beauty of applying, again, these mathematical tricks in finance. All right? So here, right? Now let's talk about the fact that the ROC is a ratio. ROC is a ratio, right? It's not a whole number. Because of, and ROCs, we can have positive ROC scores and negative ROC scores, just like returns. How do we deal with this? We deal with it just like we dealt with it with returns. We add 1 to each. For instance, let's say we have these quarterly values right here, these 5 ROC values. 2 of them are negative. How are we going to deal with this? We're going to add 1 to each ratio, multiply it, and then raise it to the power 1/5, and then subtract 1. Does that look familiar to you? Yes. That is exactly how we take annual returns or quarterly returns, whatever, and then normalize them into an average compound return. Same concept. Same concept. Do you see now? That is why we use geometric mean. The concept is the same. In this case, the answer is going to be negative 24%. There was consistent, in those 8 quarters, there was or I guess 5 quarters in this case, their ROC was consistently at a negative 24%. Yeah, we see a 60% here, 100% here, don't matter. And that's why we actually like to take the average of ROCs. 8 quarters are average of ROCs, geometric means, so we get a nice, solid average that penalizes variation, right? Penalizes variation. All right, so let's go ahead and calculate ROC, right? We can calculate ROC using our data RDS table, right? We got it. I'm going to create a new table called DFR. We could have done this all in one shot, but it doesn't matter. We'll go ahead and do it side by side real quick. I have this right here, so I'll do it pretty fast. Right here. So first things first, I already have my data table here. And I believe my data table is already, actually, we'll do that in a second. It's right there. So let me create a subset of the data like we did with earnings yield. I'll call this table DFR. And I have a slight problem where my quotes are all messed up, so I'm going to fix the quotes real quick. Alrighty. Fix that there. Fix that there. And I'm basically grabbing all the values I need for my formula to calculate ROC. Get rid of that space. Right there, right there. Okay, excellent. Get rid of that space. That's going to cause me an error. All right, this should work now. Oops. Oh, undefined. Oh, here we go, growth property. That's the problem right there. Boom. Now I'm going to, over here, I'm going to rename the columns just like I did before, make my life easier, all lowercase, nice, and easy. All right. Boom. Now I'm going to go ahead, convert it to a data table, change the ordering, and calculate the ROC, which is very simple. All right. This is now data table. This is now going to make sure the order is by tickers and date, just like we did before. And now, once I have everything ready to go, this is basically my formula for ROC. I'm done. If you look at DFR now, we have an OI, we have an ROC. Done. Excellent. From here now, we want to do, remember, like we said before, we want a, we want the geometric mean of the 8 recent quarters, right? The current quarter and the 7 previous ones. So what I'm going to do is I'm going to employ my shift like I did before, and this time we can use it going backwards like we did before, right? Let me press enter so it's easier to see. And again, I have to fix the quotes. And right here, it's pretty obvious what I'm doing, guys. I'm creating 7 new columns called R2 all the way to R8. And these are going to be shifted, the ROC column, by 1 to 7, all right? And I'm going to do it by ticker because, again, this is within each ticker. I don't want a ticker, for example, I don't want Apple towards the end of its time, like 2017, grabbing, or I'm sorry, I don't want it from the beginning of its time, like 2007, grabbing ROCs from the ticker before it. All right, that's why we're going to do it by ticker. I run it, done. That easy. And now, I don't know if you guys can see this. There we go. Let me slide it over. I'm now just going to create a new column called ROC8, which is basically going to be 1 plus ROC times 1 plus R2, R3 times blah, 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 on and on and on, all the way to R8. And then I'm going to raise this, whatever this product is, to the power of 1/8, and then subtract it by 1. Again, I'm just applying the formula for a geometric mean right there. I'm doing it directly. I go ahead, I run this, and I'm done. I have my ROC8. It's that easy. From here, now, I'm going to now move over my ROC8 to my daily price so we can do some more graphings and talk about it a little more. So I'm going to move my ROC8 over to my daily price, just like I did before. Done. And now daily price has ROC8 as well, right? Now daily price has ROC8. And so that's how quickly we did it. And that's how easy it was, guys. All right. So back to our analysis now. Now that we have the ROC8 there, let's go ahead and run back the 3-day return between Apple and Tesla and the 3-day return. And instead of earnings yield, let's use ROC8, right? And if we do this, you're going to get this little funky graph right here. So let me go and grab the graph I have from before. Again, I copy this. And the only change I make is that instead of, I'm going to do it to versus 3-day return, and I want to compare it against now my ROC8. Everything else is pretty much going to be the same. Oh, let me change is dot finite to ROC8 here as well. And that's how quickly and easy I graph it. Right now, look at how funky this is. What's going on here? Well, notice these little bars, vertical bars going over here, like these vertical patterns. What's going on here? Unlike earnings yield, ROC8 does not have a daily input. ROC8 is strictly made by quarter ending or annual ending data points. So ROC8 only changes quarter to quarter, right? It's only going to change quarter to quarter. So for certain periods of time, it's going to be the same value. And that's what you're basically seeing here. You're seeing here 1 quarter of data, another quarter of data, another quarter of data. And within this quarter, you're seeing the wide range of basically the 3-day returns, Once again, notice Tesla has a negative ROC8. That is because their operating income, obviously for this time period, was negative. Their ROC8 is going to be negative, okay? And you see those wide range of returns. Same thing with Apple. In Apple's case, we do have positive ROC. We do have positive ROC, but again, we don't have some sort of linear relation. There's no strong linear relationship. It looks like it's, again, has no direct linear effect. All right, and just like before, we're going to use the pairs function on ROC8 to see if we can find some sort of pattern, direct linear pattern. And I'll just go ahead and grab my pairs one here. Copy that down here. Change this to ROC8. ROC8. Zoom in. And again, we're down here. Here's a 3-day, 5-day, 20-day, 60-day. What do we see, people? We don't see anything. We don't really see a positive relationship of any sort, right? We don't see a positive relationship of any sort. This is disheartening, but did you really think it was going to be that easy, guys? Right? First of all, I always state how I hate regression. Not because I hate regression. I don't want to hurt any statisticians' feelings. We have great statisticians in our department. I hate regression because it doesn't work, or stats in general doesn't really work in the financial field because our data is not linear. It's not linear, and it's crazy, right? Right? This is the reason why we employ other different techniques, more advanced techniques that we're not going to really talk about this semester. But this is basically the point. This is basically the point of how you discern these facts, these patterns over here. All right, but nevertheless, we will try to attempt to create some sort of strategy using ROC and earnings yield, or see if we can create some sort of strategy that's coherent just off these two ratios. So here, there's no direct linear relationship, which is unfortunate, but I mean, we kind of knew it wasn't going to be that easy. All right. Now let's explore ROC8, earnings yield, and positive returns all together. Right. Let's check out what's going on over here in a little more depth. Now, first things first, let's see what my range of my data, my whole data. Let's see what range of earnings yield and ROC8 we're dealing with. Right. And we're going to employ something called the summary function. Right. The summary function, if you guys remember from stats, gives you your 5-number summary plus the mean. 5-number summary plus the mean. All right. And what the hell is the 5-number summary? Median, first quartile, third quartile, max, and min. All right. That's basically what we mean by your 5-number summary. And visually, it can become a box plot of sorts. All right. So let's go ahead and knock that out real quick. All right, so here, notice the summary function. Notice I'm filtering for only situations and data where I have both a quantitative number for earnings yield and ROC8, right? Oops. I run this. Here's my results. We got a crazy outliers over here. Crazy outliers, right? Minimum over here, the max over here. These are just crazy numbers. Within the first quartile and third quartile, which is 75% of the data, we have more meaningful numbers between a negative 0.003, so that's what, a negative 0.3%, all the way to 75% quartile number of a 2.3%, right? 2.3% earnings yield, right? Again, this is across. Before we were just looking at Apple, Tesla. Now we're looking at all our tickers across our data. Now, if this is too much data for you guys, depending on your computer you have, again, like take a subset, take more recent data. In fact, we're going to do that when we start visualizing because this is too much data to visualize. Your computer will take way too long, especially mine. All right, if mine takes too long, then yours is definitely going to take a little too long. All right, so let's look at now ROC's range of numbers. All right, again, you have these crazy outliers. A little scientific notation over here. So we got crazy min over there. We got crazy max over here. But within those 75% of the data, again, you have a 0 ROC ranging all the way to 1, an ROC of 1 in some cases. I'm looking at first quartile and third quartile. Your mean, notice your median is 0, is virtually 0, and your mean is some crazy number. Why? Because as we know, the means are highly affected by the outliers. Okay, and so the ROC outlier, the ROC outlier is clearly much more wider and crazier than the earnings yield one. Right. Now let's kick this up a notch. Let's graph this. We can graph this visually as well using a histogram. But I'm going to take only the most recent 3 years, from 2015 onward all the way to the end of 2017. And again, this is just for your computer. This is just for the sake of your computer. if your computer can't handle this much data, right? Even, we reduced it. If this is still too much for it, take the most recent year or even maybe the most recent quarter, right? Go ahead, work with something that's manageable for your machine. All right. Notice I'm trying to make a bins. I'm using a histogram. If you guys remember what a histogram is, the histogram was those bars that numerically counts up. Again, this is from stats. It counts up all your different ranges of numbers, right? This is for numerical data. And here I'm explicitly specifying, give me 20 bars, 20 bins, 20 bars. And Ggplot will figure out, the histogram will basically figure out how to break up all the data into 20 different buckets, what the width should be, and to put them in there. Now when I run this, by the way, notice that little stop there, it's running. I zoom in, I get this nonsense right here. I get one block and all this space. Why is this? Why is this happening? This is happening. First of all, notice most of my data is here within the 0 range. Fantastic. All right. So why is this happening? This is happening. Which one was this for? Excellent. So this is for basically the 3-day returns, right? This is basically for 3-day returns. I'm looking at the 3-day returns relative to where I have discrete. I'm looking at the distribution of the 3-day returns where I have discrete values for earnings yield and ROC8, right? And this is now for the last 3 years of our data from 2015, 2016, 2017. So 3-day returns, they aggregate around this 0 value, which makes sense. And then we have all the space right here. What's happening? What's happening is we have outliers. And because of these outliers, we have a histogram that goes out all this way. You can't even see it because these numbers right here, the counts are so massive, right? So the count is, so there's very small amount of numbers with these high amount of 3-day returns, okay? That's cool. I like high 3-day returns. So let's check this out. What's going on over here? All right. Let's now see my summary is quantitatively for my 3-day returns. I'm going to use a summary function here. I'll borrow this right here. I'm going to do it for turn 3. But remember, I want it for where date is greater or equal to 2015 -01 -01. All right, and this is the beauty of having date objects in your data. You can filter like this, chronologically like this. Boom. And this is what we're seeing. All right, fantastic. In the last 3 years, my 3-day returns are, I have anywhere from -98%, wild, right, all the way up to 88 times my money. That is not 88% right there, guys. That is 8,880% return in 3 days. In 3 days, you would have not doubled. There's some stock out there that in 3 days, for whatever reason, it did not increase by, it didn't increase 100%, 200%, 300%, not by 1x, 2x, 3x. It increased by 88x. This is basically saying, hey guys, if you put $100 in this stock in 3 days, you would have got how much, guys? You got 88 times that, right? So basically, roughly 88 times your $100. So you would have had back of 8,800, basically $8,800 from your $100, right? In 3 days. That's not bad, right? What the hell's going on there? How's that happening? Well, I kind of know what's happening. I'll explain in a second, right? But let's visualize this as well, right? You can visualize this as well. What's going on? Here's your 5-number summary. We can get a better picture if we do a box plot. And again, let me take this right here, and instead finite greater boo boo boo. Thank you. I'm gonna box plot instead. So on my y-axis, my return is gonna go, and I'm just gonna change this to box plot. And by the way, again, I want to point out the superiority of doing using Ggplot versus Tableau to do this kind of analysis. I literally do copy and paste, change a few things, and I'm on my way. This plot's taking a while. Let's give it a second for me. If it's taking this long for me, it's going to take much longer for you guys, so you might want to reduce your data if you can't keep up, if your computer can't keep up. All right, here it is. Look at that. Oh, shouldn't have zoomed in. There you go. All right, here are, again, this is strictly, we're looking at the distribution of the 3-day returns. Here is 0. Notice your box, you can't even see a box, it's just a line. And notice how wide it is. That's basically telling me, okay, cool, excellent, right? This is how much of my data, my 3-day returns is around 0%, right, roughly. But look at here. This is 25x, 25 times increase, 50x increase. Here we see the 80 increase we were looking at, 88 increase. There's another one up here. There's a whole bunch here. There's a lot right here, right? There's a lot right here. That's crazy. Let me look into that. I have no problem with a 3-day return of giving me crazy returns like that. Can that be repeated, right? That's the question. And where are we getting this? Where are we getting this nonsense from, right? So ret 3, actually, from that graph, we can see there's many outliers beyond the 100% gain in 3 days. That's insane. That is insane. How and why is this happening? All right. Well, first of all, let's quickly do a quick mathematical trick to basically figure out. Let's do a quick select, count select over here using the .n property. To figure out how many, real quick, how many 3-day returns I have in the last 3 years are actually greater than 50%. That's why I'm putting this extra filter here, greater than 50%. 1,913. Okay, 1,913. That's actually not that many compared to our total amount of data we're dealing with, right? If you think about it, let me grab this. Get rid of this filter now and see a total amount of numbers we're talking about. So yes, so out of like 2 million something, 2.3 million 3-day returns with stocks in those last 3 years, 1,913 were like, boom, greater than 50%. Let's look at that, right? Let's look at that. Let's explore that a little bit. Because, I mean, it might be something that we actually care about. So here now, I'll put up a plot of, first of all, I'm going to go ahead and put a plot here. I'm going to take a subtable called D3, and this is just so it's easier for me to plot. Basically, whatever I did here, I'm going to get rid of the .n. I'm just going to filter daily price just for these features, put it into this new table called D3, and I'm going to graph this D3. When I graph this D3, I'm going to put the EY on the x-axis, the ROC8 on my y-axis, and I want the individual dots to be now be affected by the return 3 value. Because the return 3 value is a numeric data and not a categorical data, right? Now remember, in terms of data science, there's numerical and categorical. We haven't talked about that much, but categorical are basically data that's not considered numbers, even though they can be numbers, but they're not something you can apply mathematical transformation to because they stand for something, they mean something. They're a category. They stand for some sort of category, right? But here ret 3 is a numerical data, right? And for that region, it gives you a range of colors, right? Most of the obviously are dark because it's probably around, by the way, again, this is 20x, 40x, 60x. This is not 20%, 40%, 60%, 80%. This is 20 times your money, 40 times your money, 60 times your money, 80 times your money in 3 days. So down here, if we're doing greater than 50%, around here will be like greater than, well, all the values at 50% or greater than that. And that's why you see mostly dark blue. All right, so let's graph this. Let me first create my D3. My D3 is going to be this guy. Get rid of that thing right here. Boom. I got my D3, and now let me graph my D3 table the way I wanted it. All right, boom. And notice that was much faster. We're dealing with much less data here. All right, so we got outliers here with earnings yield. We knew that. We got outliers that were ROC8. We knew that from before. It's kind of messing up my analysis a little bit. I can't really get in there and see what's going on, right? I can't really see the light blues anyway. They're hidden somewhere from me. All right, so let me deal with this. I want to zoom in on that area more. Too much variation in numbers. If we can limit, let's start limiting our data even more. Now, from here, let me just tell you a little trick. I already know where a lot of those crazy returns come from. A lot of the returns come from penny stocks. Yes, there are penny stocks in our data. Okay, and yes, penny stocks are a great great way to make incredibly a lot of money and lose incredibly a lot of money. The latter being mostly the case. Penny stocks don't have liquidity, okay? And most of the people that own the stocks are the people that launched the company. And a lot of times they could be some shady companies, all right? They're looking to pump up their stock and they drop it, okay, on you guys, and then they just they make their money, and whether the company does anything after that, they got nice cash payout, and they call it a day. And it's very hard to prove that they were a scam of a company, especially since they actually are trying to do legitimate things. But you cannot prove if that wasn't their original purpose. All right, classic pump and dump. Unfortunately, the Italian mafia, they're not what they used to be anymore. The world's changed. The criminal world has changed. A lot of them moved into the space, but they're not limited to that. I shouldn't generalize with the Italian mafia. I apologize to any Italian mobsters out there, but it's basically where it's shady. It gets shady. Even if it's not shady, a lot of these companies, they tend to be risky. They are usually a one hit wonder in terms of a product or service, and a lot of times that product service doesn't make it, and they tank. Usually don't see as many penny stocks anymore because now everyone moved over to the new bubble, which is Silicon Valley, right? And after Silicon Valley, then you had the whole digital currency scam going on. So that was the thing for a while. That kind of cooled off. So now, it'll be interesting to see. Maybe you'll see more penny stocks coming. I've always wanted to launch my own penny stock. Not to scam anybody. I just never really had an opportunity to do it. But so a lot of them are penny stocks. So what I want to do is I want to limit our analysis. I want to get rid of the $5. I want to filter for get anything less than $5 I want out. Let me just keep the stocks at $5, which is kind of unfair because even dollar stocks aren't that bad, right? But nevertheless, let's do it. So here, I'm going to rerun this analysis. I just filtered. All I did was it's the same thing right here, guys. I'm just filtering price by greater than $5. Right? And have fun with this. You guys can mess around with this. If you guys want to look at the penny stocks, look at the penny stocks. Check them out. Or the dollar stocks. Right? Just because I'm wary of them doesn't mean you have to be. You might be able to crack the code. All right, so here, excellent. So now from there we see that, all right, we kind of got closer in to where we want to go. We still have some outliers in earnings yield and ROC8 messing us up because here's where the action is, and I want to see what's going on there. All right, that's where the action is, and I want to see what's going on. How do I do that? Well, it's clear that the vast majority of the ranges for ROC8 are between like negative 2,500 and 2,500, and for earnings yield, it's like negative 3 to 3. So I'm going to severely filter now my ROC8 and earnings yield, right? Just so I could get a better picture of what's going on in here. All right, and here, as you notice, I did filter it more than I was going to say in the previous slide. In my ROC8, I just said, hey, give me between 10 and negative 10. That's where the action is. I just want to see it. All right, I want to get in there. I want to see what patterns are going on. All right, so I did another huge, massive filter. Let me go ahead and take this. Let me actually copy this. This is the filter I want. Oh, I should actually copy this first, whatever. I'm basically graphing this again. I'm just putting in some more constraints. Let me copy that again. All right. All right, so now I've limited my ROCA between negative 10 and 10, 3 and negative 3 earnings yield. All right, now I run this. All right. Aha. All right. All right. Now, people, we got a better picture of what's going on between these massive, and again, remember, these are massive 3-day returns we got. But look at what happened. When we limited our ROC and earnings yield, our 88x, 20x, 50x, they're gone. Makes me sad. Hashtag sad, right? But we still have 9 times return, 6 times return, 3 times return. I'll take it. I'll keep it, right? So let's break this into quadrants, okay? If we break it, let's break these into quadrants, and this is what I talk about now in the next couple of slides. From the 0 mark here and the 0 mark here on my y-axis and my x-axis, okay? Here, you have the most action going on. Look at it, most of the dots are here, where it's negative earnings yield and negative ROC8. Why? Negative operating income. If it's negative operating income, what is that? That's a growth stock. That's a growth stock. We've talked about this, right? It's negative. Investors, it's not making any money, but for some reason, investors feel it's going to make money. And look at this, and if you're in this region, it's consistently making negative amount of money. It's losing money. Then why do you have these crazy 3-day returns? This is growth stocks. Growth stocks are more volatile like that because there is no clear consensus of what the valuation is, and any assumption, and every assumption goes into these valuation models, right? And when these assumptions change or a new assumption is made, right? And remember, when these investors, these institutional investors, they're always on CNBC, Bloomberg, making their case, or they're in blogging, or they're tweeting, or whatever, all right? And they're making their case about this stock or that stock. These things change in a heartbeat. I mean, we see that we saw that this semester with Tesla in the beginning of the semester. Our pre-corona days, right? When we were in class, we saw that with Tesla. We're in class. Tesla went from 700 to like 1,000 and then back down to a 700 like the next day, right? We all saw that. Okay, that's obviously paying for the big boys, but these are smaller stocks, fine, but it's the same idea. Same idea. Now let's look at these quadrants up here. The top quadrant right here, the top left quadrant, we still have negative ROC, but now we have positive earnings yield, right? And the bottom right quadrant, this situation is where you have a positive ROC and a negative earnings yield. How is that possible that you can have a situation where your ROC is positive and your earnings yield is negative and vice versa? Because both of them have operating income as a numerator. Well, the answer lies in the fact that we're looking at ROC8, the geometric mean of the ROC, right? In that case, yes, you can have negative earnings yields and positive earnings yields, but because of the fact that the ROC8 is looking at 8 quarters past, you could have a situation where you have a stock that's in and out of positive and negative earnings yield, positive and negative earnings yield. And depending on which point in time you're looking at it, it could either end up in the top left quadrant or the bottom right quadrant. So these are the stocks that are they're the stocks that went from the bottom left quadrant and are now heading closer to profitability. There are some quarters, they're starting to see the light. They have some quarters that are seeing some sort of profitability, right? So I'd be interested in some of those stocks, honestly, looking at those stocks. And notice that's your second most amount of stocks, returns. Majority of them are here, negative. And then your second greatest amount are in these 2 diagonal boxes, which means like, look, it's negative some quarters, it's positive some quarters, et cetera, right? And that's another reason why you have these crazy returns. The smallest amount of positive returns, these high 3-day positive returns we see now, is the top right box. You see that, the top right box? Here, that's the smallest amount of numbers. That top right box means, look, you have consistent positive ROC8 and earnings yield, and the particular earnings yield we're looking at is positive, because remember, the numerator is an average of the of the operating income. And if that's positive, then the last 4 quarters earnings yield had to be, or last year it had to be positive. And if the ROCA here is positive, that means that in the last 8 quarters, we had more positive operating income than negative. So over here, this is the quadrant that we actually care about. This is the quadrant that value investors actually look at. Businesses actually making the money, right? They're actually consistently making the money. And look how small it is, right? First of all, look how small it is. Look how the data points are barely in this quadrant. That's number 1. They're barely in this quadrant. And number 2, there's so few of them. That's the reality with value investing. Finding those big movers is far and few. but it's less risky than you're playing in this space. But this is why a lot of these hedge funds, they play in the growth space, right? The high risk, high reward, high risk, high reward. All right, let's go ahead and add another filter. Right now, let's just say, I'm just going to say, you know what? Just let me focus on this one quadrant right here. I want to just focus on this one quadrant. So I'm going to change my filter to say, okay, only the positive ROC8s, only the positive earnings yields. All right. Close this. And I'll take my plot here again from before. And now I'm going to go ahead and change this to be greater than 0. Let's say greater than 0. And this one to be greater than equal to, make this like that 0 as well. Let's make it greater than 0. All right. Right, and we do greater than 0 because we want, obviously we don't want 0 operating income, we want some sort of profit. And so now I'm focusing on just that quadrant I care about, the top right quadrant, and that's all we see here. And now we can see how few data, all right, we can see how few data points we have. But again, these data points, because remember when we filtered return 3 for the D3 table, are all greater than 50%. In 3 days, we had 50% moves, at least 50% moves. Hey, if it's far and few, that's fine. That's a fantastic strategy. That's a fantastic strategy I'm looking at, right? And in this case, right, is there any discernible earnings yield or ROC ranges we should be looking for if we build a strategy? I can't really see per se, right? Majority of the data tends to be, so we do have some a crazy ROC8 here of 6. We still do have a crazy earnings yield of 0.2 out here. Actually, that's not that crazy, 20%. Right? Actually, that is pretty crazy. 20% out there, right? But majority of our dots, if we look at them, are over here. They're between what? They're between ROC greater than 0, less than 2, and an earnings yield of greater than 0 and less than, it looks like 0.05 or 50%, right? So under 200, 0, greater than 0, less than 200% for ROC, and greater than 0 and less than 50% for earnings yield, okay? I'm sorry, 5%. This is 10%. So 5%, 200% to 5%. And this is where mostly these 3-day high-end returns are. Can I build a strategy? All right, can I build a strategy where I can basically look at stocks that have positive ROCs that are greater than 0 and less than 200, and greater than 0 and less than 5%, right? And I look for these stocks quarter over quarter, or in this case, because it's a 3-day return, daily over daily. If I did the strategy, what would I get? What would be my profits at that point, right? What would be my profits at that point? Well, one, we can visually see this if we wanted to. I'm not going to give you, I mean, you visually can actually see how successful this is because I don't have this in my slide right here. Right? I think we're at the end of my slide. Yes, we're at the end of my slide. But let's try to just knock that out, right? I said what? I said 200%, 0 to 200% for the ROC, and between earnings yield greater than 0 and less than 5%? Yeah, we said less than 5%. All right, let's see that. Now what I'm going to do, guys, is I'm going to copy this again. All right. This will be on the slides because I'm basically setting you guys up for your last lab. All right, daily price. And now I'm going to get rid of this price feature. Should I get rid of that price feature? Let's keep that in there. All right, let's keep that in there. So now, the reason I'm going back to daily price is because remember, we filtered D3. Where do we filter D3? Where are you, D3? Right here. We filtered it for returns, 3-day returns that are greater than 50%. By the way, we have other returns to look at. We haven't even looked at that, right? It's just for the sake of time factor. I'm not looking at it, but I mean, again, we're at the precipice, the beginning. We're at the shores of quantitative research, right? With just 2 ratios and just 4 returns. We're not, I know the semester's ending, we're not even going to get to it, but I mean, now think about the fact when you have ratios, you have 50 financial ratios and all kinds of, like we're doing daily end prices. What about intraday prices? And mix that stuff in. right? It gets pretty insane, right? But here I'm looking at the daily price because now I want to see, I want to put back in my filters greater than equal to 5, ROC 8 greater than 0, and less now, what do we say, 200%. Earnings yield greater than 0 and less than now what? I said 5%, 0.05, okay? And now I want to see how do the 3-day returns spread out in this region, in this regime. I run this, and it's taking a while to run, so there's a lot of data there. Oh, you know what I did? I didn't filter for my prices. So let me close that up. Okay, good thing I told you that. So here, what I forgot to do, guys, is I want to filter for the last 3 years. I pressed the stop. Hopefully you guys, your computer didn't get messed up. I'm sorry. All right. So here, let me do that again. But this time I added the additional filter. Of the date, right? Because I don't want it to be too crazy. So taking a pretty while. All right, looks like it stopped finally. So look, on my machine it's taking a while to do, so on your machine it might be too much. You guys might want to actually reduce the date range instead of the last 3 years, take the last 1 year, because this is taking a while. So it just finished processing here, and it's still trying to process the graph right here. Waiting. Okay, boom. There's a lot of ugliness there, right? I can't even begin to, this is way too much data. I apologize, this is way too much data to look at, right? So this is way too much data to visualize. What we can do is, right here, it's way too much data to visualize. So what I'm gonna do is, guys, real quick before I end this video, I'm going to use the summary function from before, and this will be able to handle at least giving us a range of what we're dealing with here. All right. So here we have a minimum of a negative 68% loss following this strategy. We have a quartile, first quartile between negative 1.5 all the way to positive 1.8% return. And we have a median of 0, 1%, 1%, and a max of 326% return. Okay, look, this is pretty crazy, right? This is pretty crazy. Using that filter we talked about, okay, that we backed out of basically using the scenario where the prices were return was greater than 50%, right? If we were just to now apply this in more vanilla strategy, it looks like your returns are going to be all over the place. It looks like the returns will be all over the place. It does not look like it's going to be a good strategy, right? It does not look like it's going to be a good strategy, but nevertheless, we can test it out, and we are going to test this out. All right, we're going to test the strategy out. So this is a great place to stop. The next part of the lab basically is, and this is your final, this is going to be your final lab, where basically I want you to actually do, just like before, we did a simple investment strategy with earnings yield, using earnings yield, right? We did 8 different strategies. Now we're going to do 4 strategies. We'll stick with the 10 stock, we'll stick to 10 stocks instead of 1 stock each. So 4 strategies, and actually no, we're just actually do, I'm sorry, just 1 strategy we're going to test, and we're going to basically test the strategy of, this strategy of where, hey, where the price is going to be greater at least $5, and the ROC is positive, but it's less than 2. And we could refine this actually even more if we wanted to. And with the earnings yield is greater than, is positive, but it's less than 5%, right? And we could refine this even more if we wanted to, right? But I'll do a wide range one. You guys can actually mess around with it. And I'm basically going to see how this strategy actually did, right? How the strategy actually did. This is a 3-day strategy we're now testing. And that's where we're pretty much going to leave off. If you guys want, I would recommend, why don't you guys save your daily price table because we actually need this daily price table going forward. So what I'll do is I'm going to go ahead and save this in my directory. I'm going to do sessions, choose directory, and I'm going to choose my class Spring 2020 for investment. Oh, let me make sure I'm in the right one. Nope. Let's go back here. I chose the wrong one. Documents, investment modeling, Spring 2020. Oh, perfect. And here now, what I'm doing, I'm setting my directory. You'll see that change over here to this semester's class. And now I'm just going to use the command save RDS, right? I'm going to save my daily price table so that when we do next week's lab, or when you guys do next week's lab, I believe lab 6, we actually tried this. We tried this 3-day trading strategy, test out how well it did. You can just use the same table that we already have all the data in. It makes life so much easier. And I'm going to say this as daily price. Call it 5 as of 5 meaning lab 5. Dot RDS. Remember the dot. It doesn't matter what name you give it. Just please make sure you give it the dot RDS extension. Click save. Notice it's taking its time. Notice how long it's taken to read that back in. Notice, by the way, it's also daily price is already a data table, so that file is being loaded back into my hard drive. And again, if you have limited space, by the way, notice it's still running. If you have limited space based on your computer, feel free to delete your original daily price. There, it took about less than a minute for me, but it might take a few minutes for you guys. So if you have space as an issue, go ahead and delete the original daily price, because now we have this one, daily price 5 again for lab 5, and we can use that for lab 6. All right, guys, so this was a brief introduction to how we apply visual analytics to quantitative researching. And as you can see, hopefully you saw that this actually generated a hell of a lot more questions than it answered anything, right? And that's good. That's the point. That is research. That is good research. And from good research comes great analysis. The more questions that you can write, good questions on your data, on your analysis, on just the results you're seeing, the better and better you will get at being an analyst, a quantitative researcher, a data scientist, or whatever you want to call it. All right? It just so happens that our semester is ending. Ideally, if we had an investment modeling part 2, we could take off from this point and talk about automating our trades in a paper account using interactive brokers or Ameritrade, whatever. So our program basically will trade automatically based on different models, whatever. That's neither here or there, but anyway, hopefully you guys, this kind of opened the door for you guys, even though it's very confusing as to what you're seeing and there's so many more questions, but it opens the door into actual what quantitative data analysis or data science really is about. Okay? All right, guys. This is the end of this video. We have one more lab coming up, and I will see you guys at the Q&A session. All right, bye-bye.